Well, first of all, bull steepener is bullish for bonds. Yields are coming
Correct.
down, which means bonds prices are going up. If correlations work the way that they should, as bond prices go up, stock prices go down. It doesn't mean everything is bullish. It doesn't mean bullish for the economy. It doesn't mean bullish for the stock market. Now, there are parts of the stock market that do tend to do well in bull steepening environments. I've talked about these sectors before, and they are healthcare, staples, utilities, and energy.
A warm welcome to the On the Tape podcast, Guy Adami. I'm joined by Elizabeth Young Thomas. That would be EYT. Elizabeth, how are you?
I am great. How are you? I like
I'm
Mondays.
great. I'm great. I feel as if the Yankees have turned the corner. It is
Oh,
Monday, and we're actually going to get into that. Of course, the great Mamas and the Papas. I know you're a fan of the
mm.
Mamas and the Papas. Michelle Phillips, of course, Cass Elliott, that, of course, Mama Cass Elliott, John Phillips, and Denny Doherty. They were the four members of the Mamas and the Papas, and they sang a song, Monday, Monday. So good to me. Monday, it was all I hoped it would be. Is today everything you hoped it would be, EY?
Well, it's still early. It's early, so I'm not sure, but I was singing that song, and I don't know that I would say I'm a fan, but you were shocked that I knew who it was by.
I
I
was
definitely
shocked.
did not know the band member's name, so kudos to you on that.
Well, I'm older than you are, and I'm a fan of that genre of music, but it is going to be an interesting listen. I thought last week was an interesting week in the markets. I think this week will be as well. I think we have 32% of the S&P reporting that. Of course, if they're 500 companies, I can do that math. 160 companies. Microsoft to me sticks out. You got Facebook, Qualcomm, Apple on Thursday. So a couple energy stocks on Friday. We're not going to get that granular, but just speak to what you perceive to be the importance of this week, given the fact that, look, despite the little sell-off we've seen, the market has hung in there extraordinarily well against a backdrop of things that, seemingly could provide some headwinds.
So, first of all, you mentioned some big tech names. This is still a quarter where the Mag 7 is expected to contribute about 60% of S&P earnings. So that's a big chunk, which anybody who's listening, that is why we are still hanging on every word of those big tech companies when earnings come out and all the announcements that surround them. I still think that this will be the quarter where, and it started to happen last quarter too, where AI has become a zero-sum game. You spend on it, but you have to prove where that spending is going and where the profit is going to come from. So I think investors have supported the spending on AI up until now. Now they want the rubber to hit the road. Where is the money coming from? So there's a lot more discernment going on in the market. I think that continues, but I think earnings season also continues to have some surprises here and there. We've had some surprises. We had a McDonald surprise today. It was not a great one, but there are some surprises here and there that will continue to happen. But I still think broadly earnings season will end up solid for Q2. It's the rest of the year. Expectations have come down a bit, especially for the fourth quarter. That's not necessarily concerning. Expectations usually do come down, but it's about whether or not we can actually hit those lofty targets in the face of a slowing economy.
Well, so you mentioned McDonald's, and what's interesting is we're sitting here, despite the fact that, again, it was a bit of a miss on McDonald's, and we haven't seen, McDonald's struggle the way they have in quite some time, and they cited basically the pullback that consumer has been in the midst of. And listen, again, a bit of a relief rally today. I think as we're sitting here, it's up about 3% or so. But it's not necessarily the stock performance. It's some of the commentary that we continue to hear out of a lot of, listen, we're not only hearing it from retailers, we're hearing it from different restaurants, we're hearing it from a wide swath of industries, both on the low end and the high end. And one has to wonder, if they're trying to basically tell the story that I think you feel has been going on for quite some time, and I do as well, but for whatever reason, the market is not taking its cues from.
Yeah, the thing about McDonald's that's interesting, and Doug Cass sent me a chart on this. I don't know if it was last night or early this morning. There was a chart about fast food inflation. And I believe it featured a number of different restaurants, but I'll tell you this, most of the lines moved up and to the right. So those are the restaurants that consumers expect to be affordable consistently. And if they've started to creep into a different echelon of pricing, we all know what the next echelon would be, right? There's the fast casual type pricing. If they've started to creep up people are deciding that they're just not going to pay it anymore. And this is a consumer. We know that inflation has bitten the consumer on the lower end much harder than it's bitten the upper end of the middle class or even the luxury consumer. So this is a consumer who has been pressured by inflation for years now. And if they're starting to pull back on some of those smaller purchases, it is something to pay attention to. Now, I think companies like McDonald's, other lower discount retailers, there's a bunch of companies in that category. I think they will make efforts to adjust and bring prices down. I think McDonald's has already done some things about different types of meals or different types of combinations to bring the prices down. And I think that will continue, but this is definitely something to note. And it's something that as we watch the data, the consumer data, it can be misleading because it's just big, broad strokes, right? We see retail sales, we see consumer spending, we see the savings rate. Those are big, broad strokes of consumers. But when you break it up into different levels of income, it tells a completely different story.
Which leads us to the next topic because, again, people are clearly feeling the impact of the cumulative effect of inflation over the last 3, 4, 5, whatever it is. And I think in many regards, that's why this administration's approval rating when it comes to the economy is as poor as it is. It's got nothing to do with the stock market. It's got everything to do with the fact that people are hurting out there without question. But again, not being political, but it leads us to this whole Fed rate cut cycle. And Wall Street Journal article, a Fed rate cut is finally within view. Fed officials aren't likely to change interest rates in the coming week. Their meeting, I believe, is this week. You know this better than I do. But there's obviously a lot of chatter around it. And, I don't think they're going to move either this week, but I do think what we're setting up for potentially, and you've talked about this, is a September cut and maybe as much as a 50 basis point cut. Again, I'm not an advocate of that, but I think there's some market participants that, if you get 3 rate cuts this year, it might come in the form of a 50 point cut in September and then a subsequent 25 point cut somewhere later in the year. Thoughts on that?
So, what's interesting is last week, the chatter about a July rate cut started to heat up because of a paper that was released by a Federal Reserve president that said they need to cut rates now. Last week, the odds or the probabilities that were in the market of a July rate cut were about 6.5%. Maybe they got closer to 7%. They've come down. They are now sitting at 4%. I don't think they're going to cut rates this week. Jerome Powell does not like to surprise the market like that. It's not going to be in good taste to surprise the market like that. Because if they surprise the market this much, now it would be different if the odds were 50-50 and they did it. But they surprise the market this much with 96% probability that they won't cut. If they cut now, I think it sends a message that they know something's wrong that other people don't know. And that will not give people a good feeling. So if you look into September, yes, the commentary has heated up about a 50 basis point cut. I still view that as a pretty outside probability, as a contrarian view. Now, that could change from now until September 18th when that meeting actually happens. There's some data that's going to come in. We've got jobs this week. We've got more inflation data that we're going to get in September as well. So there's still a lot that's going to happen before then, and those odds could come up. But right now, the market is, and it's moving a little bit this morning even, only expecting about 10% odds of a 50 basis point cut in September. But that 25 bips is fully priced in. I think the beginning of their cutting cycle should be gentle. I think they should be gentle unless something goes terribly wrong between now and September 18th, where they need to come out and send a message that we're here to help. If they don't have to send that message, they should start this gently.
I agree with you. I mean, part of what again, there's that whole Shakespeare thing. Uneasy lies the head that wears the crown, and what it basically means is when you're in a great power position. I mean, you're never going to really sleep well at night because there are a lot of responsibilities. So I don't really have that much sympathy because they're in the seats for a reason. But I'll say this: you layer on top of everything you just talked about, with again we're in this presidential election cycle. And regardless of what people say, it will be politicized by maybe both parties, but clearly on one side of the aisle. I do think if we were to see a rate cut of the magnitude of 50 basis points in September, there will be cries that this is political and they're trying to help one side as opposed to the other. So we'll see. So there's that aspect of it as well. But, there's a lot of people that think, again, and Bill Dudley, I think, was the paper you were regarding, the Fed's somehow behind the curve. We'll see about that. But what you've talked about is the importance of the yield curve. And when a lot of people seemingly have forgotten about it, one thing you've been saying for quite some time, it's not the inversion, it's the re-steepening. And I think, we talked about it, you and I, last week. Where did we get to? About 11 or 12 basis points of inversion, I think, in the fall of last year ish. We've gotten down to the high teens recently. Depending on the time of day, it's probably floating either side of 20 or so basis points, with the 10-year coming down and the 2-year coming down a little bit faster. So thoughts on the re-steepening of the yield curve, because a lot of people will say it's a bull steepener. They hear the word bull and they decipher that must somehow be bullish for the market. But you know what? History suggests otherwise, I think, EYT.
Well, first of all, bull steepener is bullish for bonds. Yields are coming
Correct.
down, which means bonds prices are going up. If correlations work the way that they should, as bond prices go up, stock prices go down. So it's a little bit of a misnomer, right? And it's a little bit misleading to say it's a bull steepener. There's also bull flatteners. It doesn't mean everything is bullish. It doesn't mean bullish for the economy. It doesn't mean bullish for the stock market. Now, there are parts of the stock market that do tend to do well in bull steepening environments. I've talked about these sectors before, and they are healthcare, staples, utilities, and energy. So those are sectors that you can still be in if you don't have a position in, maybe time to look at, because as we go through that period where the yield curve continues to steepen, and I think that will happen as fall comes nearer and as we get into winter, I think we'll come out of inversion this year. We actually did intraday get down to an 11 basis points or so again last week. So we're sort of knocking on that door. We're flirting with it. We're not there yet, but I think we will come out of inversion this year. And that is a totally different environment than what we've been in. The inversion itself is usually bullish for stocks. And as it stays inverted as deeply as it was, or just gets more inverted, that's usually bullish for stocks. As we start to re-steepen, stocks tend to not do as well. Bonds do better. So this is something that I think people are going to have to work on their muscle memory for, because we've been conditioned that tech is going to do well all the time. High growth stocks are going to do well all the time. Nothing does well all the time. So the idea of this rotation that we're seeing right now into small caps, we've seen things like financials catch a bid. That's all positive, but it's also very natural as rates are coming down initially. But as we enter a new phase where the yield curve continues to steepen, perhaps uninverts, and economic data slows, those sectors that have been seeing a decent rally of late, including small caps, could run out of steam.
One of the things that I've sort of put out there is that in the United States, somewhere between 65 and 70% of this economy is driven by people buying things. When people have jobs, people tend to spend. When the stock market seemingly goes lower left, upper right, and people sort of equate the stock market with the economy, people will continue to spend. And that's sort of regardless as to whether or not they should be. I've always said, never question U.S. consumers want to spend, just question whether or not they should be. And I'll put that out there. And I do think they're probably stretched. With that said, I thought the unemployment rate by this time, and I talked about it in the fall, I thought by the middle of the summer of this year, which we're in the midst of, I thought the unemployment rate would be north of 4.5%. It is not. So I just want to be crystal clear. However, it has been going up. And you've talked about the SOM rule and the impact of that. And there are no really hard and fast things. And maybe we shouldn't drill down as much as people are. But, we're on the precipice of sort of, I guess, triggering that. So spend a minute and talk about the importance of that and these job numbers. And again, we've talked about the revisions, 13 in the last 15 months or so, these negative revisions. I happen to think that the job market is not nearly as strong as the unemployment rate suggests, and the pundits want to make you believe that it is. Talk to me about, I know the importance of the job market, but some of the metrics around it.
Yeah, so when we hear things like the labor market has cooled, a lot of times what people are referring to is the idea that we were at a point where we had 2 jobs open for every 1 unemployed person. That was a tight labor market. We didn't have enough butts to fill the seats, okay? Now we've gotten back to a point where it's 1.2. The ratio has come down to 1.2. So we went from 2 jobs per unemployed person down to 1.2 jobs per unemployed person. That's about where we were pre-pandemic. So when we hear about labor market cooling, that is largely what people are referring to. That feels like a more comfortable level. Jerome Powell is happy with that level. The issue is, can we keep it at that level and not let it drop below? So where we are right now, things are still fine. When you look at the unemployment rate, we get the jobs data this week. So we're going to get non-farm payrolls. We'll get the unemployment rate. Expectations right now are for that rate to stay at 4.1%, which is exactly what it was last month. The SOM rule will trigger if it goes to 4.2%. The SOM rule is when you take a 3-month average, the last 3 months of the unemployment rate, if that average is 50 basis points above the lowest reading of the last 12 months, that's when the trigger happens. So if we go up to 4.2 this month, that average will be 50 basis points above the low. That would be where the SOM rule is. Now, why do we care about the SOM rule? Because it tends to be a pretty good indicator of a looming recession. Now, you and I have talked about this many times about if you just, it's very simple to look at a long-term chart of the unemployment rate. Anybody can pull it up on a database called Fred. You can find it a lot of different places. Super long-term chart. There's a ton of data available. If you just watch the trajectory of that rate, you watch it hit a low and it does this little U-shaped thing for a while. It might stay at that low for a while. And then as soon as it turns up, it hits escape velocity pretty quickly on the other side. It goes up a lot faster than it comes down. That has happened every single time. Now, what people are hoping is going to happen this time is that it will go up a little bit so the labor market cools and the Fed can cut rates and be comfortable with that, but that it won't hit escape velocity and that it'll sort of level off at a comfortable spot. The last thing I'll say about this is, okay, then what's a comfortable spot? 4.5% is probably a comfortable spot. Getting above 4.5%, creeping into that 5% range, getting a little uncomfortable. But generally speaking, somewhere between 4 and 4.5 is an accepted full employment number.
So you make a great point, and I think if my math is right, the SOM rule will get kicked in if the average is 3.9%, which would be 50 basis points above, I think, the low tick, which is 3.4. You can correct me if I'm wrong, but I think I'm in
I
the
think that's right,
ballpark.
yeah.
So that's number one. Number two, the optimist will say that, we're probably triggering that at historic low levels, so maybe it's different this time. Maybe it is. I listened to Larry Summers talk, and he basically is echoing what you just said. It's the escape velocity. Again, just the same way the Fed couldn't control the inflation that they begged for years, to think that they can control the unemployment rate, I think, is folly as well. And when things start to move, they move, especially to the upside, a lot faster than the market realizes. And I do think you're going to probably see this sort of stair step higher in the unemployment rate that the market is not expecting, which leads me to this. We've seen a rotation clearly into small caps. Everybody's been talking about it for the last 2 weeks. Do you think, it doesn't matter, I guess, if it's justified or not, it's been happening, but do you think the market's getting ahead of itself? Because quite frankly, if things are somewhat deteriorating, especially in terms of the labor market, it stands to reason that the small caps probably shouldn't be doing as well as they have over the last couple of weeks.
Yeah, well, what's interesting is the contradiction, and actually, I'm going to steal this a little bit from Ed Yardeni. He was on Squawk Box today, and I think he made a really great point, is that if small caps are rallying right now because the economy is doing so great, why haven't they been rallying for the last 2 or 3 years? Why have they not hit new highs? So that can't be the only reason that they're rallying right now. It can't be that suddenly we've entered early cycle behavior again, or even mid-cycle behavior, and small caps are rallying because their earnings are suddenly better than we thought they were, or because there's this huge expansion going on in the economy. If that were the case, small caps would have hit new highs just like the other broad indices did. This is now their 6th attempt, if I'm counting correctly, at getting above their previous not new highs, right? So they still need to get back to that new high or that high that they had in late 2021. Haven't done it yet. Maybe this is the moment, but they're not there yet. And I think that they need a little bit more of a tailwind from economic growth in order to get there. Now, their earnings are expected to improve going forward, which is a good thing. And that does give some people reason to believe that there's fundamental support behind this rally. But I think much of the rally has been predicated on the idea that rates have come down, the inversion has narrowed, and we've seen a rotation out of big tech because they were so largely overbought that the money needed somewhere to go and it just didn't want to exit equities. It was looking for other growth opportunities. So it's gone into a lot of those small cap names.
The other thing, and the money's coming out of technology, it appears, out of tech into small caps. But I saw something from Bloomberg, and again, I want to emphasize, timing mechanism in terms of PE multiples does not work. You can't time the market when you look at multiples. However, you have to take them into consideration. What I've said for a while is the higher these multiples go, the less there's not a lot of room for error in terms of what the market can do. And this Bloomberg piece suggested we're seeing tech multiples that we haven't seen in the last 22, 23 or so years. So clearly we're extended on that side of the equation. I only mention that because of the names we have reporting this week. And we saw a story about Apple, and I know you don't want to get granular, and I'm not asking you, but they're going to delay, apparently some delays on the Apple side of things in terms of AI. I don't think it's necessarily hurting the stock, but clearly there's been a rotation out. So once again, I ask you, how important to the broader market are these 8 to 10 names that we seemingly talk about all the time, especially now on the precipice of some pretty interesting earnings releases this week?
I think they're very important. And if those 8 to 10 names do not come through, at least in price action in the market, you need a lot of strength from the other names to pull up and make sure that we can stay where we are. Now, a couple good things about it are that I mentioned earlier in the show that the Mag 7 still expected to contribute 60% to earnings. That number goes down considerably in the third quarter and the fourth quarter. So it goes down to about 30% in the third quarter, down to 20-ish% in the fourth quarter. So we won't be quite as dependent on the Mag 7 for earnings data in the third and fourth quarter. If the market is able to hold up, that means that we must be getting strength from other sectors, so those need to pull through. So that's kind of what we're hinging on. Now, your point about PE, I think this is important to talk about. High PEs do not necessarily suggest that we've got this huge catastrophe coming. It doesn't mean that we're going to have a humongous pullback. High PEs suggest that the forward returns on those stocks will be muted. How far forward? 5 to 10 years or so, right? These studies about PE ratios and the timing of them aren't really statistically significant unless you're looking at it over at least a 5-year time horizon. It's not even great at 5 years. It's better at 10 years. Here's the issue with it. No investor has 10 years of patience. Nobody's going to sit around and wait during a period of muted returns. So generally speaking, high PEs come down because people got impatient through a period of lackluster returns. I say that all just to make the point that the returns that we've experienced from a lot of these big tech names have been beautiful. And I applaud anybody who has taken part in all of them. They cannot continue forever. And I think we are at risk of what's called recency bias, believing that it's going to just extrapolate out into the future. And even if they stay positive, they cannot continue at this clip forever. So we have to be looking at portfolios and making sure that we're looking for opportunities in other places.
You basically teed this up perfectly for me. There's an account that I think you follow. I know that I do. His name is Bob Elliott, and he put out a tweet. I think it was earlier this morning. This obviously being Monday, with almost half of the S&P 500 companies reporting so far, the 9.8% earnings growth year over year this quarter. That's up 0.9% versus initial expectations. Looks pretty good. That's until it gets compared to the 17% expected year-over-year earnings growth expected by the fourth quarter of this year and the 15% growth for 2025 too. And what he basically saying, this isn't just a tech story. Double-digit earnings growth is expected across the vast majority of sectors across the economy by 2025, reflecting the fact that it's going to take a lot more than just tech leaders to get there. So you do need at a certain point the commensurate revenue and earnings growth. It can't just be multiple expansion. And as I've said for a while, I think 85%, and Doug Cass has talked about this as well, of the move since October has been predicated on multiple expansion. And at a certain point, you need it to sort of flip so you start to see the commensurate earnings and revenue growth. So I think you've addressed it, but so drill down just a bit more on that.
Well, which, by the way, mathematically, if we have strong earnings and prices don't move as quickly, that means the PE comes down. But I think for good reason, because then you've got more support. PEs are at risk when they've expanded for not really great reason, or if they've gone up too quickly with not enough fundamental support to prove why they've risen. So if we have earnings that continue to be strong, but an index level that stays flat or rises marginally, you will see PEs compress. But that's not necessarily a bad signal. I think that's rational behavior, and it gets us back to a place where not everything feels overbought. So there are some measurements, and Strategas quotes this a lot. If you look at the number of stocks in the S&P that are above their 200-day moving average, you want that percentage to stay above 60%. I believe right now we're hovering somewhere in the mid 60s. So under the surface, the market still seems relatively strong. We've got some buoys underneath us to support it. It's not like there's this huge sell-off that is in motion and everybody's running for the doors. So I think that that's a good thing. And again, talking about second quarter earnings, I don't think there's going to be anything broadly that's going to tell us second quarter earnings were terribly disappointing. So I think we're okay through summer. But when we start hearing more dovish commentary from the Fed, when we start hearing that inflation continued to come down and we can't pass through prices anymore because they're not increasing as much anymore, you're going to see those revenue lines from companies get hit. And that's also okay as long as companies are managing their operating margins. And that's what people are going to have to be, number one, as investors, very discerning about. Number two, companies are going to have to be very careful about how they're managing that through the end of the year and into 2025.
Real quick, just according to FactSet, the trailing 12-month PE ratio for the S&P of 25.7 is above the 5-year average of 23.5 and above the 10-year average of 21.5. Again, we're not suggesting these are all timing mechanisms, but it's important to understand, what we're looking at just through the lens of where we've been historically. And I think it's important. So this week, as we mentioned, a slew of earnings. Dan and I will talk about it. You'll talk about it on Market Call this week with us as well. But there are a couple things this week, again, in terms of the economic data that I think is interesting. Tomorrow, the 30th, we got consumer confidence. Again, there are different consumer confidence ones. I'm not sure necessarily how important this one is to you, but we have one tomorrow. Wednesday, ADP employment, we'll see. Obviously, we got the Fed on both Wednesday and I think Thursday of this week, if I'm not mistaken. And then Friday, unemployment. So there's a lot to sort of take in this week. What do you, out of all those things, what do you think is the most important? I'll throw it out there. I think the Fed is important. I think the jobs number is the most important.
I agree with that. I think the jobs number on Friday is going to be the most important. The Conference Board consumer confidence that we get tomorrow is the one that skews more towards the labor market. But also the other thing about these surveys, both Conference Board and the University of Michigan survey, they're taken over a period of like 5 days. So whatever consumers are feeling over that 5-day period is how this survey is going to come out. Conference Board skews more towards labor. University of Michigan skews more towards inflation. Because we haven't seen any very troubling labor signs yet, I do not expect this Conference Board index to be terribly troubling tomorrow. The Fed will be important, not because of what they're going to do with rates. I don't think they're going to do anything with rates, but I think they are going to start skewing a lot more towards labor commentary. They're going to talk about the jobs market. We might even hear a little bit more dovish tone from Powell this month because of some of the data that's come in since the last meeting. So as they shift to more dovish, we could see volatility in what the rates markets are expecting. And I think the bond market is actually at risk of seeing volatility this week, maybe even more so than the stock market.
I agree with you. Again, with rates where they are now, I appear foolish. I've looked smart at times, but I'm still one of these people that think there's a surprise to the upside in 10-year yields. I understand why 2-year yields are coming down. It makes sense. Obviously, the Fed controls the front end, and if things are slowing down, it stands to reason that we would see 2-year come in the way that it has. But I also think there's a supply-demand thing going on in terms of longer-dated yields, which is going to be, I think, negative for bonds, or in other words, yields go higher. So we'll see, Elizabeth. But there's clearly a lot this week. I do think, again, for a summer week in the middle of the summer in July, I think this is a pretty important week. And I think the VIX is telling you that as well. Before we get out of here, for the first time in a while, we've seen sort of the volatility index sort of peeking its head up. I think last week, if I'm not mistaken, we saw a VIX, it almost got north of 19 at one point, got close, 18 and change. And here we are sort of flirting with 17. So and I'm not saying anybody should trade this, but do you think the renewed life and the volatility index is trying to tell the market something?
Absolutely. I'm still not sold that the VIX is the same thing that we used to look at 10 years
Agreed.
ago, and it might not be. It may never be that sort of measurement again, but I do think that it's moving up because things have gotten more jittery, because there's been bigger swings, particularly in yields, but that affects stocks a lot too. So, I think it's important to watch, but remember, the VIX is something that spikes. It doesn't go up and stay up. So when you see a VIX spike, it's usually over pretty quickly.
Duly noted. There are medications for that, but that's for a different show. When we come back, Caitlin Malin and I are going to sit down with Chris Ryan, the head of liquid active strategies at Galaxy. So stick around.